Half an hour away from the opens in Hong Kong, Shenzhen, and Shanghai. You're watching the China Show. I'm Yvonne with David Ingles.
Yep. Happy Monday morning. Let's get to your top stories today. Equities across the region making a positive start to the week, even as traders bet on continued market volatility. Investors are waiting, of course, a U.S. inflation print that could be key to the next, with the Fed's rate decision, of course, coming up, and also the latest activity numbers are due in the next few days out of the Chinese mainland. Now, it's also a big week ahead for Chinese tech earnings, with Tencent, Alibaba, and JD.com set to give us a snapshot of economic and also consumer sentiment. Now, the heads of India's market regulator denies claims by Hindenburg Research of conflicts of interest over the Adani Group.
Did you have a good weekend? Did you rest up after the week that we had? Certainly, braced for maybe a little bit more volatility, as some have called, because it looks like right now we're still seeing that relative calm across these markets after we basically reversed some of the sort of the manic Monday that we saw just a week ago. But certainly still, markets are a little bit on edge. I have a pretty busy week, whether it's eco data out of the U.S., that U.S. CPI print on Wednesday is going to be the next catalyst potentially for things to start moving again. And then we have a lot of central bank action as well. So there you go. Right now, to take a look at how Asia equities are doing. Japan is closed, and maybe that's why we're seeing less of this FX volatility here today. Dollar yen is still on the weaker side here, 146.77 for the yen right now, after we basically saw that those yen shorts were basically slashed last week. You're taking a look at how Nikkei futures are looking like. We're still punching higher. The Kospi, the TAIEX, both, of course, tech heavy, are all seeing gains of more than 1% here today. So there is a sense of things, maybe stability. U.S. futures, though, mind you, are still in negative territory. We're seeing a flat dollar right now. And bond futures are still slightly in the red this morning, ahead of that inflation print as well. We're watching very closely commodity markets. A little bit of downside when it comes to Brent, but iron ore is a bit weaker, about 1% in Singapore here right now. And we're seeing when it comes to Treasury yields as well, that 10-year yield basically has returned to the levels that we last saw before that U.S. jobs report as well. So we got to wonder what's ahead for bond traders here. Of course, are we likely going to be re-engaging with some of these recession calls again soon? You take a look at how China is set up here. We did see an upside in the Nasdaq Golden Dragon on Friday here. There's been some interesting sort of calls, whether it's Goldman talking about the renminbi, saying, short CNY over the basket. For one thing, they've benefited, the CNY, from this whole unwind of the carry trade, but they're saying the PBOC hasn't really been quite there to support this yuan rally as well. Something to keep in mind here as we count down to that MLF this week. Monthly data dump that's happening this week as well. Futures are pointing negative here this morning, 223, seeing a bit of a rally in the Chinese 10-year yield here after we did see bond market sell off last week, and 717 for the currency, Dave.
Yeah, with the yields pulling back as well, is this an entry point as far as the CGB market is concerned? Our guys at Bloomberg Intelligence think that the target certainly is this guidance from the PBOC to 2.2%, which is where we are here on the 10-year yield, to 2.25%. So as Yvonne is pointing out, it's a big week ahead as far as eco goes. So on Thursday, that's when you get the activity numbers out of China. Before that, though, is that crucial CPI print out of the United States. Today, as far as CPI goes, by the way, we have India coming out with their reading on that as well. And, yeah, going into the rest of the week, you have Hong Kong GDP, and, of course, you also have, of course, in terms of the jobs numbers coming through, jobless claims in the UK, and also the unemployment rate out of Australia. This is classified, as you can see, by the type of data point we're getting. Right. As far as central bank decisions go, we have a big week, of course, ahead.
Yeah, I mean, you talk about RB and Z, so they're facing a crunch policy decision this week. Some economists and investors are still unsure, really, where rates are going to be. Are they going to start talking about cutting rates or wait for further evidence that inflation is returning to target? But also, when it comes to the Philippines, so the BSP will probably hold, right? But that hold is also expected from the PBOC after it surprised the market with that 20 basis point cut in July. For more on what to expect this week, let's bring in Taosha Wang, portfolio manager at Fidelity. There's been, after what was a meltdown basically last week, things have at least cooled down a bit. I'm just wondering, where do we go from here?
I feel like the market volatility is, investors trying to form new consensus in a previously very crowded place. And I think the question really is, has that new consensus been formed? Has that a lot of the, the lever trade being unwound? And are there new, narratives in the market that we should pay attention to?
Okay, I notice you're slightly building on your cash positions, and you've been de-risking part of your portfolios. Tell us why.
We think the macro narratives have two key macro narratives we have been paying attention to. One is in Japan and the other is in the United States. Okay. We think that in Japan, the macro narrative has truly changed in the sense that the country is now caught between two very strong opposing forces. One is domestic reflation and the other is a slow external environment. We think both these forces are powerful. They will probably persist for some time. So I think the macro narrative in Japan is a little bit more, delicate. We're seeing, and it's slightly different from, a common bullish stance that a lot of market players took in this part of the world. In the United States, we still think, a soft landing is probably still the base case scenario. Yep. Although we are watchful of data. But what has driven a lot of market reaction there has been the increasing scrutiny over the AI and tech trade. Because a big part of the AI boom so far has been driven by the investments, not by commercial applications. And people are wondering, what is the financial sensibility of spending so much money in such a short period of time?
You wanted to show us this chart that basically shows what global semiconductor sales and the correlations that it actually has to the ISM prints that we see in the U.S. What does it tell you right now?
Sure. The semiconductor is not the only AI trade, but it's a key beneficiary of AI trade. It's important to remember that this is still, at its core, a growth cyclical sector, and historically has had very strong correlation with global manufacturing GDP, PMI. Sure. What this means is that every upcycle, every downcycle typically has its typical duration, typical magnitude, and it has a typical correlation with the PMI activity. What we are currently have gone so far in the upcycle, we're currently in this time is different territory, and you have to find very strong justification to say this time is different. AI is a very compelling thesis, but the market will have some doubt.
Yeah, so in other words, what we're saying is because the ISM has started to pull lower, we probably will see chip sales start to move lower as well?
I think there's certainly pressure that way. Because that is, semiconductor, this is not the first semiconductor cycle. There has been many, many cycles. Historically, by the time the upcycle has turned so much, there's usually more pressure for it to go south. So we'll watch.
How does one discount then that information, given that most on the street are still bullish on the structural AI story?
Absolutely. I mean, even for us, we're not a tourist in the AI trade. We believe in this fundamental, of the long-term upside. In the short term, cyclically, it's important to remember that AI is still a very young technology. So if you look at its adoption rate and commercialization rate, it's tracking very well. But it is a young technology. It is dependent on a lot of investments, and investment decisions can swing based on human, discretion. So essentially, you have sort of two conflicting forces. One is the typical cyclicality, and the other is the AI trend that we think will have long runway. And I think sometimes it's a growth cyclical, higher highs and higher lows, essentially.
You also slashed your overweight position in Japan. I think it was right before the BOJ decision as well.
With the timing.
Yeah. Well, what did you see then?
For a long time previously, a key benefit for owning Japan is the big reflation story. It was also, in a lot of other parts of the world, inflation was a big problem. And for Japan, inflation was just, simply a good thing. Corporates are regaining pricing power, etc. So, that was sort of the uniqueness of owning Japan. Fast forward, we've held that trade for a very long time, and fast forward, we've come to a position where sequentially we see, growth potentially slowing down in many parts of the world. China growth is remaining lackluster. So Japan is sort of caught in this place where the domestic reflationary force is still very strong, and BOJ potentially the next move is still towards up, but then in a more challenging external environment. We just thought that story has become more complicated. Rest of the world inflation not such a big concern. Japan wasn't as unique a position in the portfolio anymore, so we sort of reduced risk.
Right,
there.
and relative to China, where is Japan? So Japan is what? Have you closed out Japan, or is it China or your market weight on Japan?
Yeah.
And on China?
We're a little bit more conservative on China.
Okay, but what does it mean specifically?
It means we don't have too much. We only own China for the idiosyncratic good opportunities at this moment. Yeah, not as a big macro trade.
Right. Looking at how many months do we have left in the year? About 3 or 4 months at best. A couple of central bank decisions left. What do you think the biggest wild card is?
Yeah.
What is materially the most consequential factor that drives returns moving forward?
I think the biggest central bank to watch is still Japan and the U.S. Okay. In Japan, they need to be very careful. It feels like they have to hike still because, again, we talk about the persistence of that domestic reflation coming out of decades of deflation. That reflation force is still strong. Right. But the timing of it and how they frame the message is very important, and we saw them sort of becoming more, aware of the potential risks there. And obviously in the U.S., now the range of possibilities becomes so wide, right? I don't think the market has agreed on either a recession, which we think is excessive, or, a soft landing, which, a lot of that expectation has been shaken out. So I think the market is still trying to form a new consensus there.
You still think U.S. is your preferred market, or at least the one that's still going to stand out?
Yes.
How do I factor in the election risk later on this year?
We're not a political expert. But when we put in a trade, we try to be mindful of the multiple catalysts that could be at play. If some of the political or policy risks are too high, then we will be just a little bit more aware of it. So on this note, healthcare is sort of a new overweight position, a new and bigger overweight position, precisely because we feel like the policy risks there and geopolitical risks there are relatively small. It's a defensive sector in a broadly, more volatile market. And it also has, exciting long-term growth opportunities.
All right. Taosha, thank you. Taosha Wang there, portfolio manager at Fidelity, to kickstart the week with us as well. And we just want to put a little bit of a correction of what I said earlier about what the BSP and what the expectations are right now. So I think Bloomberg Economics expects things to stay on hold, but consensus still thinks they actually could cut here this week, too.
Yeah, they'll begin that. And I think it's that the expectation of a reduction in rates out of Manila, I think, is consistent with, was it Nomura that we spoke with, Sonal Varma?
Yeah.
A couple of weeks back, last week, that they brought forward their expectations of a cut out of the BSP. And, of course, that is, coming on Thursday as well. Right. Just ahead, and speaking of looking ahead to the week here, China is looking to speed up its shift to a greener economy. And we'll look at what that entails and perhaps a market reaction to that policy pivot later on when markets open up. 17 minutes away. We're counting down to the open of trade in Shanghai and Shenzhen, and in an extremely wet and rainy, amber warning filled Hong Kong Monday morning. Hope you're all covered up. It's Cheap Shoes Day today. If you haven't left the house just yet, hope you keep dry and keep safe. The open, 16 minutes away. This is the China Show.
PBOC also stated to continue lower funding costs for businesses and the households. So altogether, we are forecasting a triple R cut for the third quarter, and a 25 basis point triple R cut and 10 basis point cut in policy rate in the fourth quarter. And our rate forecast is predicated on the view that after Fed cutting rate in September, that will open the door for China to continue cut policy rate in the fourth quarter.
Goldman Sachs' chief China economist Shawn there. Your renminbi fix just crossing the Bloomberg, and it's 714.58 against the dollar here today. So once again, a fix here that is, in some ways, the central bank pushing back against some of the strength that we've seen for the renminbi of late here. So we're at 717 levels here right now, but certainly we continue to see that strength in the currency here after that beat in CPI on Friday as well. So certainly one to watch here, but that fix has basically stayed above that 713 handle for the past 2 weeks now. In terms of what to watch today, of course, we're watching some key technicals for the MSCI China, testing that 200-day moving average, those falling HIBOR rates, in which Dave had been mentioning last week as well. We're still in that window for data when it comes to FDI, credit data as well, of course, as we count down to the big monthly data this week as well. And earnings. We really are starting to get more of the big earnings out of China. Big tech certainly is going to be a key focus here today, Dave.
Yeah, in fact, when you look at the pockets of the market where we are seeing, the most favorable revisions higher, it's really in tech. And, all of our guests virtually tell us that as well. Oh, activity numbers, there we go. That's also due out on Thursday. Keep in mind, that's your estimates as far as July is concerned. Okay, why don't we talk about earnings? Yeah, so when most of our, if not all of our equity strategist guests talk about the Chinese market, they talk about quality, they talk about tech, they talk about growth, and you really see that reflected. If it's not a barbell approach, by the way, if you had to pick one, it's that. It's a barbell approach. I'm getting into a rabbit hole here, but in any case, of course, the revisions are most favorable when it comes to benchmarks that are levered to the tech story, right? So normalized based on an index, HS Tech has seen the most revisions higher, 10% from the start of the year. CSI 300 is down about 7% year to date, normalized as well. Now, on an index level, so the question is, have Chinese earnings completely recovered? I mean, the short answer is no. Are we seeing net positive revisions? The answer is yes, of late. So I think we're now up to 2 or 3 straight months of net positive revisions higher. That's the story right here. This was your reflation story back, of course, when things reopened from COVID-0. This is, of course, going into COVID as well, and also some of the conversations and regulatory issues around tech. And, of course, going into the 2020 story, that's, of course, COVID. And this was, of course, your domestic story as well. So this is where we are relative to, I guess, where you are in the peak. But this is where we are relative to where we were at the bottom, Yvonne.
Yeah, you got to wonder, are these earnings going to be enough to at least break out of this downtrend that we've been seeing basically in Chinese stocks as well? The tech sector certainly has been more the resilient side and what's been driving a little bit more of that optimism when it comes to earnings, but certainly the rest of the market is still looking a little bit uncertain here right now. Still, you have analysts talking about when are we going to see that bottom when it comes to those earnings downgrades as well. For more on what we're watching out for China today, we're joined by our team, Asia Equities reporter Charlotte Yang, also our China credit reporter Wei Zhou as well. Charlotte, I'll start with you. What's going to be the top theme this week?
Yeah, this week is definitely about those July economic activity data that's dropping Thursday, and then we have a bunch of earnings. So starting with the eco data, on Thursday, I think investors will pay close attention to the new home prices after that sharp, after the June's reading showed that sharp slowdown, and then everybody's also watching the retail sales. That will also, surprise people, missed on the big margins. So that's what people are watching on the economic side. But from earnings, we have Tencent Music coming on Tuesday, and then Tencent on Wednesday, and also we have Alibaba, Lenovo, JD.com, and a bunch of them coming later that week. I think what particularly will be important will be on Tencent, and given how this company, the Chinese social media giant, was the one to be able to surprise investors on the upside last season and give that a bit of the boost on the sentiment. So I think Tencent's everybody's attention will be focusing on that.
What about the macro story and the Chinese market story? So this global unwind of the carry trade and what that means for Chinese equity markets?
Yeah, so some strategists such as Bloomberg Intelligence, they think that, as the yen carry trade unwinds, we might be seeing more resilience with the Chinese market. At least for last week, you're seeing the MSCI China outperforming regional peers and was up 2%. So I think the main story is still that the valuation-wise is looking very cheap. You have MSCI China trading less than 9 times multiples. That's below regional peers and also below its own 5-year average. And with that, you have the expectation of Fed cutting rates soon and the strengthening of RMB. So that probably will give PBOC more wiggle room to boost the economy. But with that said, if we're just looking at the flow-wise, last Friday we had a big outflow from foreign investors, and I think whether valuation is attractive enough to bring people back, you have to have the economic data this week, and also the earnings have to surprise.
Wei Zhou, we got some key court hearings today, this week, I should say. Kaisa, Times China. What sort of risk are we facing here in terms of liquidation right now for these two developers?
Yeah, Kaisa was sued by a group of creditors after it defaulted on a dollar bond in 2021. And Kaisa has been fighting against their efforts for about a year, but Kaisa still hasn't managed to come up with a restructuring plan. And the judge of Hong Kong High Court already said in June, if it doesn't present like evidence that of a concrete restructuring plan today, it may end up being forced into liquidation. And this is significant for China's struggling real estate sector, as Kaisa carries more than $32 billion in total liabilities. If it gets one day up, it will be the second largest Chinese developer to be liquidated just after China Evergrande.
Now, on, I guess, the more positive note here, Logan and KWG have managed to secure some money to backstop this luxury project here.
Yeah. So Logan and KWG, they secured a private loan to refinance a facility of over $1 billion. This loan facility is to back up the Corniche project, which is a luxury real estate project in Hong Kong. And the original 10 billion Hong Kong dollar loan was set to mature on August 25th. And the backers of this deal include some of the major players in the market, such as RRJ Capital, Deutsche Bank, and Pacific Investment Management. So this refinancing plan will pave a path forward for Logan to restructure its offshore debt. Well, the Corniche itself isn't included in Logan's restructuring plan. It has been at the center of negotiation, as the ability to secure refinancing for it is viewed as a bellwether for how viable the developer's debt plan is likely to be.
All right. Thank you so much to get us started for the week here. Wei Zhou there on credit, and of course Charlotte on equity markets. The opening bell just under 7 minutes away. We're looking at a flat open in the Hang Seng Index. More full preview, of course, of the trading day ahead. This is Bloomberg. Right, welcome back. Good morning. Good Monday morning. And we're looking at how would you describe this? I'll go with flat, because I woke up kind of in a bad mood. I'm kidding. Slightly to the upside. If you look out the window, the clouds have parted slightly here in Hong Kong, so you are getting slightly less rain, slightly more light coming from these markets. Hopefully that is a signal of what's to come ahead of the open here.
I don't know. I mean, I think, is the coast really clear is what everyone's asking. In terms of analyst actions today, some interesting calls when it comes to some of the brokerages in China. Also, SMYC, H shares raised to a buy at DBS Bank with a price target of $24. Haitong Securities, CICC. So basically, JP Morgan coming out and cutting their calls on when it comes to some of these Chinese brokerages. So underway for Haitong, overweight, though, for CICC here right now. You are, of course, watching the China show. We got the open coming up next. This is Bloomberg. Welcome back. You're watching the China show. We're counting down to the open of markets. And, it seems like, just like the weather, things are looking a little bit dreary right now. We're flat when it comes to the Hang Seng pre-market. We're still having some lingering questions of what lessons were learned from last week, given this global tech sell-off, given this unwinding of the yen carry trade, which has actually now subsided a little bit here as well. And also, is volatility really here to stay, or is the coast really clear? And we have some key data, especially out of China this week as well, to deal with.
Yeah, activity numbers coming through on Thursday. We have a rate decision, too, on the MLF. And I believe, of course, they did, do that an off-cycle move on the MLF. So does that not mean the move that was supposed to come came already as well? The move down in bond yields on Treasuries now begs a question to Yvonne's point, right? If vol is over, is it actually is it worth taking the additional risk of taking on additional duration? We can talk about that later. Of course, Franklin Templeton will be joining us in about an hour as well to talk us through fixed income and FX markets. In the meantime, though, we'll look at the open today. You had a drop into the Friday close, taking us to a new 6-month low on the CSI 300. We are getting some weakness coming through, not a lot. We're opening flat effectively here across these markets today. In terms of earnings, it's a big one, of course, this week. As far as the big tech is concerned, right? So Tencent, Alibaba, JD.com are all reporting. We'll talk more about that in a moment. As far as the bond market is concerned, though, some sources have told Bloomberg that this is a story that came out on Friday, that officials are asking the state banks to keep a record of who the buyers are that are coming in once they start selling, of course, some of these CGBs as well. Maybe an additional measures being put in place to try and sort of stem this drop in yields. Although that said, of course, it really comes down effectively, ultimately, to where you are as far as inflation and reflation is concerned. Right, Hong Kong is looking like this: 0.2% to the upside, 37 points to the upside on the Hang Seng Index. Slightly more green on your screens here, 0.6%. As far as Tencent goes, 200-day moving average is the next one that's going to be in focus here. We're very close to that. We just dipped below that last week, and that will be your immediate resistance level on the benchmark itself. I guess it depends on what these tech earnings look like as far as that is concerned. Okay, do we have any... No? Okay, we can talk about it later. Some of the moves across the casino space right now leading some of these declines across the early goings. We're down 3% on Galaxy Entertainment. We're down 3% on Sands China as well. So this might be on the back of that story, of course, which came out in local news in Macau, talking about how the government's decision to criminalize illegal money exchange activities, which could lead to a near-term share correction, according to Citi, and that could be a buying opportunity, according to them.
Yeah, so certainly that's a bill that people are talking a little bit more that might lead to some downside for these stocks as well. Let's talk a little more about what we've been hearing on Chinese state media, because they've basically been outlining government plans to make significant progress in reducing pollution and carbon emissions by 2035. Let's bring in our China correspondent, Min Lo. We've seen this all across state media. Tell us more about the plan.
Yeah, it is a very ambitious plan, a 33-point guideline issued by the State Council to transform the economy to a green one over the next decade. And it's, of course, part of President Xi's pledge to peak carbon emissions by 2030 and to hit zero carbon emissions by 2060. And it's a plan that covers many different sectors, from agriculture to public transport, for instance, increasing the use of new energy vehicles in public transport, including buses and ships, making new energy vehicles the dominant mode of transport in the automotive sector, increasing the consumption of non-fossil fuels in China's energy mix to 25%, encouraging a lifestyle where people save food and water, for instance. So pretty comprehensive plan that Chinese state media is now touting as China's unwavering commitment to contribute to its climate change goals.
Well, we know this is a broad initiative for many, many years. I mean, you look at the industrial policy that led us to this point. How significant are all this new information right now?
Yeah, I would say that it is very significant, because this is just the latest in the spate of announcements that were released earlier this month. And one of the key shifts, I would say, is China kind of changing the way it targets climate change goals, from reducing carbon intensity to reducing carbon emission volume. So what this means is China used to be able to claim success in reducing carbon intensity when carbon emissions grow slower than GDP growth. So if GDP growth grows faster, even if the emissions volume increase, they are able to say that the intensity has gone down. But now they are reframing that to reduce carbon emission volumes starting from its 15th five-year plan, which kicks in 2026. So that's quite a big shift in its priority. And the government is also trying to upgrade its overall national electricity grid. It's setting pretty aggressive targets for the provinces to hit when it comes to renewable energy consumption. So taken together, it suggests that China is getting serious. It is perhaps less concerned about fears around energy security. It's more confident that renewable energy is able to meet its power demand. And some of that is already paying off, because China's carbon emissions was down by 1% in the last quarter. And some analysts are saying that this is a signal that China could already be peaking emissions more than 5 years ahead of its own target.
Min, thank you so much. Min Lo, our China correspondent there. Now, that story is actually topping news coverage in Chinese media today. And here are other stories we're actually tracking in today's China Brief. The China Securities Journal has actually published a piece warning investors, and we just talked about, of course, the latest measures we're hearing from sources on banks being told to keep a record of the bond buyers here, warning investors of risks in sovereign bonds as authorities are ramping up efforts to curb the rally. It says how low long-term yields are unsustainable and that traders should assess market risks rationally. Now, the article also says strong regulatory signals are expected to push yields higher. You have state media outlets also flagging progress in terms of pushing in terms of affordable housing. This is another story here. The report says cities including Shenzhen, Guangzhou, Xi'an, and Hangzhou are stepping up in accelerating construction as well as ensuring land supply.
And meanwhile, the Global Times is criticizing Manila after an incident involving the Philippine and Chinese air forces flying over disputed waters. The paper quotes observers and military experts who say the Philippines' actions ignored China's goodwill efforts and bolster, quote, Manila's victimhood narrative in the South China Sea. More on that story now. We've also heard from the Philippine President Ferdinand Marcos Jr. saying that actions by China's Air Force against a Philippine plane over the South China Sea are unjustified, illegal, and reckless. Bloomberg's Andrea Colanzo joins us now from Manila for more. Andrea, can you talk a little bit more about what we've heard from the president so far? I mean, how different is this from past encounters?
So the president, President Marcos, has described this as worrying. He said that it's worrying that we have hardly made any progress in trying to calm tensions in the sea, and now we are seeing some instability in the airspace. So this encounter over the last week is different in past encounters because this involves the airspace. So if you may recall, in the past months, we have heard the use of water cannons, skirmishes involving Coast Guard ships between the two countries. This time around, we're hearing that the conflict, the tension involves Air Force planes and the use of flares in the airspace. So it really adds another area or another arena in the conflict.
And broadly, how does this then affect general stability in these conversations between the two? Because we had a period of stress a couple of months ago, and then we had followed by weeks of relative stability when they managed to agree on certain codes of conduct, and then we have this now. So how does this look moving forward?
So that's right. So we're trying to see if this new encounter, if this new conflict will jeopardize or affect the efforts to calm and ease tensions in the sea. So you're right. In the past month, we heard China and the Philippines reaching some sort of understanding on how to carry out missions in the South China Sea involving boats that have been having encounters in the past, and we've seen this. We've seen signals that these efforts have paid off because the Philippines carried out a mission recently without any encounter, and now we're hearing another tension in the airspace, and we'll see how tensions in the air will essentially affect negotiations about sea missions and sea actions between the two countries.
And in terms of what's next, what are going to be some things, guideposts and stuff to watch out for now?
So the first thing, the most immediate thing that we're trying to watch out for here in the Philippines is how the Philippines will handle this diplomatically. So most likely there will be some sort of diplomatic protest that will be filed, and in broader terms, we will have to watch out how this will affect how both countries act in the South China Sea. So will this lead in more patrols for China in the Philippines in the airspace? Will the U.S. as the Philippines treaty ally help the Philippines assert its claims now in the airspace? Or the reverse, will this will the efforts to ease tensions in the sea extend to the airspace? So we will see in the coming weeks.
Andrea Colanzo in Manila for us. Now back to markets here in Hong Kong. One group of stocks seeing some pressure in the early goings this Monday. Casino stocks seeing some declines in the order of about 2 to 4% here. This is on the back of there's a new bill, not so much a law just yet. It's an illicit gambling bill that seeks to criminalize illegal, well, soon, if it does, of course, head in that direction, illegal money exchange activities, and it could actually lead to jail time here based on, well, what the offense would be. Currently, the conversation is 1 month to 5 years. You are seeing, of course, declines on the stock market right now. Citi says that this dip is probably an opportunity for longer-term investors to buy in to this. So Citi coming out with a note expecting this dip, and they say, yep, have a second look, is what the guys at Citi are saying here.
Yeah, something to watch out for. But there could be some buying opportunities, just given this weakness as well. Some other top global headlines that we're tracking today. The chair of India's market regulator is strongly denying claims by Hindenburg Research of conflicts of interest related to the Adani Group. Hindenburg published a report on Saturday saying Madhabi Puri Buch and her husband invested in offshore entities that were allegedly part of a fund structure in which billionaire Gautam Adani's brother Vinod had also invested. Hindenburg says the investments were made 2 years before Buch was appointed to the Securities and Exchange Board of India. The couple called the allegations, quote, baseless. Ukraine's president says Russian troops have started a fire at an occupied nuclear power plant, calling on the world and the International Atomic Energy Agency to react. Volodymyr Zelensky said in a post on X late on Sunday that radiation levels were within a normal range. Earlier, Zelensky called on allies to allow Kyiv to strike deep within Russian territory as Moscow hit back with missile strikes following last week's cross-border incursion by Ukrainian forces. Israeli forces are defending Saturday's deadly missile attack on Gaza, saying the strike was aimed at a Hamas command and control center embedded within a school and adjacent mosque. Hamas reported about 100 people killed in that attack. Meanwhile, Israel says around 30 projectiles were fired from Lebanon towards the area of Kabri in northern Israel, but no injuries were reported there. Israel remains on alert for possible retaliation from Iran on its proxies after the assassination of senior Hamas and Hezbollah leaders.
Just ahead here on the China Show, a new poll gives Kamala Harris a narrow lead over Donald Trump in 3 battleground states. The latest on the U.S. presidential race just ahead. This is Bloomberg. Good morning.
We would try to be mindful of the multiple catalysts that could be at play. You know, if some of the political or policy risks are too high, then we will be just a little bit more aware of it. So on this note, healthcare is sort of a new overweight position, a new and bigger overweight position, precisely because we feel like the policy risks there and geopolitical risks are relatively small. And it's a defensive sector in a broadly, more volatile market, and it also has, exciting long-term growth opportunities.
Taosha Wang, their portfolio manager at Fidelity, speaking to us earlier about that so-called election risk, and really a survey, interesting one, by the New York Times and Siena College, showing that U.S. Vice President Kamala Harris is leading Donald Trump in 3 swing states. For more, let's bring in Derek Wellbank. He's with us. And looking at this, so talking about Wisconsin, Pennsylvania, Michigan, Derek, how significant is this poll, and what does lead the momentum that we're seeing with the Harris campaign?
Well, it's by far the best poll that I've seen from a credible top-ranked pollster for Kamala Harris since she became the Democratic nominee for president effectively. These are 3 of the key swing states. Reasonably speaking, if you win as a Democrat, Michigan, Wisconsin, Pennsylvania, hold all the other states you're supposed to do, you win the White House. That's pretty much how significant what is referred to as like the Midwestern blue wall happens to be. At the same time, there are some other surveys that show maybe it's still in a tie state or something around there. In either case, you're kind of looking at toss-up states, right? A little bit goes this way, a little bit goes that way, and it's really down to the wire. And so what you're seeing here is a more competitive race than Joe Biden was in against Donald Trump. Kamala Harris has taken, and it's been about 3 short weeks, right? And in that time, she has taken this race, reset the narrative, pulled back into a tie scenario, infused the campaign with a ton more money and volunteers, and has really sort of reshaped the race. And it's been very difficult for the Trump campaign, and Donald Trump in particular, to figure out a way to land political blows on her yet.
Now, Derek, speaking of Donald Trump, I mean, this time tomorrow there is this interview with Elon Musk, which I would imagine, I don't even know what's going to come out of that. I would imagine that's going to dominate conversations online and over broadcast. What do we know about the setup and how that's taking place, what they're going to be talking about?
Well, Elon Musk has said that he is planning a no-holds-barred interview, no question off limits, and we'll see what they want to talk about. You know, I would imagine one of the things that'll be interesting about this, David, is that interviews that are conducted outside of what one might call mainstream media tend to focus on things that the people there are interested about, which can be very different topics than you hear about in the top-line news headlines. I would expect to hear some conversation about crypto. I might expect Elon Musk as a government contractor. He might, you know, be talking about space and Boeing and, you know, all sorts of other things like that. You know, any number of things can come up. I do find it notable because Donald Trump's biggest wealth concentration is in, you know, the DJT company that provides a social media platform in the form of Truth Social. But this is a sort of return to X, you know, one night only kind of deal. So there's a lot of things that I'm kind of interested in seeing sort of what they come into, both politically as well as, you know, on the business side for both Musk and Trump. A lot of those things we'll be keeping a sharp eye on. I can tell you, you know, we're sitting there from a breaking news perspective, very much getting ready for that. I will be watching very, very closely.
Yeah, get the popcorn ready. Now that the Olympics are over, still have things to watch. What's this we're hearing about from the Trump campaign about, you know, Microsoft telling them their campaign websites were hacked, and apparently it was Iran that was behind them. What can you tell us about that so far?
Well, there's been a difference of opinion between the Trump campaign and Iran exactly who's responsible for that. But there were some documents that were leaked to Politico, including about you know, J.D. Vance, the vice presidential nominee. I do think that this is an interesting question, right? Because remember that the 2016 race between Trump and Hillary Clinton was marked by a large focus on leaked emails and the contents therein. I have not seen the same sort of attention being paid to these documents. I think probably in part because of maybe some lessons learned, in part because the things found in them thus far have been less explosive. But look, no question, cybersecurity is a big thing for all of these campaigns. They put a lot of effort into trying to make sure that their secrets stay secret. And to the extent that there's not, there are questions that will have to be raised, not least of which, what else may have been compromised? I think that question is an open question. If you sit there and say, okay, well, you know, J.D. Vance having some things in an opposition file that might be marked as difficult. You know, gee, he criticized Donald Trump once upon a time. What's Donald Trump going to think about that? That's all old news. We all knew that. That was baked in. If there is other stuff that is there that is not already known, that would be potentially more explosive.
Derek, thank you so much. Derek Wallbank there in Singapore for us. Just a brief look away from politics slightly here. We're seeing again some movement in the bond markets in China here. A third day of declines. Today we are led, and we are seeing these losses led on the short end of the curve here. We're up 7 basis points in the 2-year. We're up 4 basis points in the 10. Just for context, on the 10, we're now up about 11 to 12 basis points over just 3 or 4 days. So markets are listening to some of these signals and selling into what's really been quite a very strong rally pretty much across the CGB curve.
Yeah, so more, I guess, efforts from the government there, and it seems to be working, at least for now. When you take a look at the bond market, you take a look at what we're seeing when it comes to Kaisa. We talked about that wind-up hearing, or that liquidation hearing. So adjourned once again to September in that Hong Kong court. So it looks like maybe we've made some progress, at least, for them to actually kick the can down the road until next month, though. So there's not much time to really kind of deliver it. But certainly, we're seeing like Kaisa shares. Looks like they're heading lower here this morning as well. We got plenty more ahead. Sorry. This is Bloomberg.
Welcome back. We're looking at some EV, effectively green and clean energy related equity market, equity names here. But moving somewhat against the grain, we are seeing some gains, not substantial, but you are, of course, seeing this against a backdrop of really what markets are generally trading sideways right now. Certainly on the back of news out of Xinhua that China is looking to speed up its shift here as far as different areas and different touch points in the economy and certain targets when you look at these 5-year plans. More on that story, of course, later on. And, of course, we're looking at markets, and as we were pointing out, flat to lower. First 30 minutes of trade in the first session of the week, ahead of a lot of key risk ahead.
Yeah, lots of companies reporting results this week, including the big tech giants, Tencent, Alibaba, and JD.com. Coming up in the next hour, we have Arete Research there joining us for a deep dive into the China's tech sector. Shawn with a new report saying, can elephants dance? Again, he's got a whole kind of pecking order of which tech stocks he likes right now. Tencent certainly is the one that's leading that charge. Going to ask him why. Plus, we're going to hear from Franklin Templeton Institute on U.S. recession risk markets and where they go from here. Plenty more to come. This is Bloomberg. Welcome back to the China Show. Here's a look at the HSI and really just Hong Kong in general. So we are still in an amber rainstorm, but things have cleared up just a little bit. I guess you could say that when it comes to markets as well, after what was a manic Monday just 7 days ago. And now we're talking a bit more about volatility stabilizing a little bit here. But have the storms, have the clouds really cleared right now for markets to, really kind of talk about risk once again. That's still kind of up in the air in some ways here. You take a look at how 8 shares are doing. We're slightly on the downside, but we're watching the sell-off in CGBs very closely, Dave. Yeah,
a third straight day. In fact, we're now up about 10, 11 basis points on the 10-year yield in China. More on that certainly in a moment. Yeah, to Yvonne's point, right? So we are getting relative is a very low hurdle given where we were this time last week. But yes, we are seeing equity markets. Ex-Japan. Japan is, of course, close to the as with Thailand, moving slightly to the upside. We're coming off, though, 4 weeks of weakness across global equity markets. So there is, I guess, in terms of value that has emerged amidst that price decline. S&P futures are flat to lower. Nikkei futures 0.9 to 1% to the upside right now. Flip the boards, please, if we can. So we talked about bonds, right? So in terms of the conversations around the Fed, you have a U.S. inflation print midweek, which is going to be very, very crucial, and then followed by some activity numbers out of China on Thursday. Now, as far as what we're seeing in the bond markets are concerned, so we should be seeing yields pushing higher in Treasury market. Cash Treasuries are closed. You are seeing yields pushing higher again across the curve in China, led by the short end. And to our earlier point, that compared to this time last week, things are certainly a lot clearer, a lot more stable, if you will. So vol benchmarks are continuing to drop just about across the board this Monday morning. So everything from VIX futures, Hang Seng Vol Index, I think is slightly to the upside, but things like the Kospi Vol Index and also ASX 200, similar measure expected vol also down a few points going into the thick of the Monday morning session. Yeah, for more on this, let's bring in our MI strategist, Mark Cranfield, joining us from Singapore. Mark, it was just a week ago. We were sitting the same spot and we're talking about capitulation, falling knives, and things have at least stabilized a bit. But do you think we've taken out enough of this froth and leveraging in this market?
We've certainly taken out a lot, and it will certainly put people on a better footing. And they'll probably be able to start looking more at some of the drivers in the background to specific markets. But we still need to see some relatively benign data, particularly coming out of the United States. Even better data out of China would certainly help as well. But investors will want to see that the overall situation is a lot more stable than it was. The bulk of the forced liquidation probably has been done, and certainly valuations have changed favorably. But if you don't get supportive economic data as well, then certainly investors have plenty of reasons to stay away. And we were just looking this morning, for example, at the 8 shares in China. They're slightly lower today, and they haven't been having a very good year at all. But one of the things going on under the hood is that implied volatility on call options really has just been declining. Every time it spikes higher, it just goes back down again. It spiked last week, and it's already falling again. And what that shows you is that long-term investors really are putting 8 shares to one side. They're not taking them as part of their major portfolio, and that's a real headwind for the 8 shares index there. They need to get over that. If you contrast it today, you can see the TAIEX in Taiwan is having a great start to the day. TSMC had a very good report about its sales of AI-related chips, and 8 shares doesn't have anything to offer on that front at the moment. So you can see investors again beginning to pick and choose between various Asian markets. That could change if we get really bad data. People just go back into a defensive mood. But when things become calmer, that's when investors have the chance to look at the relative strengths and weaknesses of different markets. And for now, they certainly prefer Taiwan compared to Hong Kong, China.
And Mark, I was wondering if we have some key earnings coming through out of Greater China this week, Tencent, Alibaba, JD.com, just to name a few. And I'm wondering, do you think there's a good enough number or set of numbers that we get from those companies that changes this perception that, the first thing markets do when things stabilize is to sell China and just go elsewhere?
Certainly, if they're strong numbers, that will certainly help. You're bound to get some sort of positive reaction. But what global investors really want to hear from these major tech companies in the China region is that they have an AI story which is going global. They want to be able to see that the outlook from those people is in tune with some of the things they're hearing outside. So if you compare that, for example, with Taiwan Semiconductor, clearly whatever's happening with that company, the whole world is focused on it. It's also related to the NVIDIA story. It's all tied in with the AI narrative. And generally, it's a pretty good big picture theme. That's what they want to see from people like Tencent, Alibaba, that they have a plan that can attract investors from around the world to benefit from AI-related stories. At the moment, that hasn't been sold very well. Maybe they will improve it maybe we will hear a much more convincing story. But when you think of the way the United States is putting restrictions on some of the Chinese-related companies, it's not going to be easy. So really, investors they're setting a high bar. They need to hear a very convincing story out of the China tech companies to believe that they can keep pace with their global peers.
Of course, the big print is going to be the U.S. CPI this week, as you mentioned, Mark. I'm just wondering, how do you think the market's positioned for this right now, especially when it comes to dollar-yen? What direction are we likely to go this week?
I think there's a pretty high bar to convince people that the Fed is not going to cut at least 25 basis points. There's still a slight chance they go even bigger. I think people have seen the recent data. The big change recently was the unemployment data. When the unemployment rate went to 4.3% in the United States, I think a lot of people changed their view. Okay, that's it. The Fed has all the information it needs. It can start the rate cutting process. And you've seen generally Treasury yields have come down. The dollar has generally been weaker. Now, of course, in the background, some of that is the unwinding of the dollar-yen trade and generally people getting fearful of too much volatility in markets. But what it sets up is it means that the CPI print would need to be very hot. It would need to come in way above expectations for bond traders to start selling treasuries aggressively and to buy the US dollar aggressively. It's unlikely that the number will be that much to change people's perception just because of one CPI number. There's still one more CPI report to come before the September FOMC, and there's another employment report as well. Generally speaking, the data has been suggesting that the US is heading towards a soft landing, but maybe with a slight risk of a harder landing as well. Those things are negative for the US dollar. They're positive for treasuries. It will take a lot to change people's view that that is not the right thing to bet on.
Mark, just to ask you about development and why we're not seeing markets react to geopolitics. I mean, a couple of things, right? All the headlines, I'm looking at my screens, all the headlines coming out of the Middle East, for example, with Israel there and some of the projectiles there, and of course, Iran. And of course, over in Ukraine and this incursion that Russia is starting to respond to, oil is barely catching a bid this morning. Are markets being too complacent, or are we just used to this at this point, Mark, unfortunately?
From a trader's point of view, it's more about history, really. I think if you go back over the past 2 decades, most of the time, if traders have taken positions too far in advance, thinking that a geopolitical event is really going to change a lot of market dynamics, they've ended up losing money. Apart from, really, the only exception in the past couple of decades was the invasion into Ukraine. That really changed the supply story. It pushed up oil prices. It disrupted a lot of things in bond markets and currencies, and it lasted for a few weeks. That's probably the only time. People who have got long memories will think back to North Korea. When North Korea first started firing missiles, people used to jump, volatility would increase, currencies would move, equity markets would fall. But gradually, each time North Korea fired a missile, the reaction was smaller and smaller. Nowadays, we barely even notice. It is very difficult for traders to make money out of geopolitical noise. Something very significant has to happen. With that in mind, they're not going to put too many bets on just because they see a few negative headlines, particularly with oil demand not that strong. Until China's economy recovers really big, then oil demand will not really pick up too much, and the prices will generally be on a downtrend. And OPEC is struggling to defend prices as well. Traders know that. So it really will take something extraordinary for people to really change their attitude towards markets just because there's a few headlines coming.
Mark, we covered everything there. Mark Cranfield, thank you, our MLive strategist in Singapore for us. And one of the things we talked about with Mark there, some of the data points this week, inflation numbers out of the U.S., India today, you also have some coming out of the U.K. as well. So keep your eye on these inflation reads as it pertains to how that might change, of course, trajectory or telemetry, just to borrow a space phrase here, in terms of central bank easing expectations. Growth numbers out of Japan coming through, and also Hong Kong and also in Singapore as far as employment is concerned. Of course, there you go. Also on your screens.
Yep. Coming up next, we have Arete Research. He's joining us to talk a little bit more about China's AI ambitions. The likes of Tencent and Alibaba set to report this week. Shawn is going to be joining also with our Bloomberg intelligence analyst, Robert Lee. This is Bloomberg. It's a big week for China earnings with Tencent, Alibaba, and JD.com among the names to watch as well. Let's get to our tech reporter, Annabelle Druller. She joins us first for a preview. Belle.
Yeah, you can just take a look at some of the big names we're tracking this week, but it is a lot of different earnings that are on tap. But there are a lot of individual stories in this that you want to talk about as well. But let's just talk about some of the big themes, and one of those has been that sort of underperformance we've seen for Chinese tech stocks over the course of this year. We've seen pockets of time where it's turned a little bit more optimistic. We've seen big gains for some of the names, but broadly it has been that underperformance, even though you've actually seen the likes of Tencent, for instance, gaining around 25-30% this year. But that's the story there, that underperformance of China tech versus, for instance, those gains that you see for the NASDAQ here. Let's change on in terms of what we're expecting this week. Still, we do have those expectations. We're going to see revenue growth. This chart here taking a look at the estimates for the upcoming quarter there, the circles there in white versus we saw in the same quarter last year. That's a positive. And you've also seen management teams, for instance, that are really committed to driving further efficiencies. You've seen that focus on share buybacks, and we've got our Bloomberg intelligence team that can focus more on that in just a moment. But still there is that concern around the outlook facing these companies as well, the headwinds, and that really speaks to the economic story in China in particular, which again puts, if you change on now, a greater focus on the economic numbers this week, and retail sales in particular one to be really tracking here, given that's hitting the likes of Alibaba, JD.com in particular, David.
Belle, thank you so much. Belle there with a preview of these big earnings coming through these next couple of days. Let's go deeper into these topics. Shawn Yang joins us right now, Senior Research Analyst at Arete Research, and also joining us today is Robert Lee, Senior Analyst at Bloomberg Intelligence, also covers tech for us. Robert, let me start with you. I mean, people tend to lump all these companies into one basket. I mean, they're sort of similar, but they're also very different when you look at the entire spectrum. Is there any specific company that you think we should be watching most closely this week?
Yeah, I think the standout, again, is a slightly uninteresting answer, is Tencent. Not just because it's the biggest, but it's the most diverse, with the biggest barriers to entry. And whilst every company faces external risks, probably its risk profile relative to some of the others is lesser, because it's typically a leader, has strong technology and market leadership in most of its end markets, and that, it's facing less external risks. Compare and contrast with the e-commerce sector, where obviously companies are facing slowdown with the consumer in China and also rising competition for low-cost players. So I think Tencent is a more robust story, driven primarily at the moment by the extreme strength they're seeing on the gaming side.
Shawn, maybe you can chime in here. You have a report saying, can elephants dance again? I'm wondering, what that means. Is that these tech giants, certainly, as Robert mentioned, maybe Tencent's a little bit more shielded from, the economic side of things, whether it's weak consumer spending and a slowdown in the economy. I know Tencent is the top of your pecking order in terms of tech stocks that you like. Why so?
Well, we have the title, Can Elephant Dance Again? I think that mainly refers to two big elephants, that's Tencent and Alibaba. Because definitely we like Tencent. Tencent is our topic. As Robert says, that it seems that it's less impacted by the overall weakness in macroeconomy, and its gaming looks very stable. On the other hand, we recently upgraded Baba, mainly because we think that Baba's management change, we're going to see some result of that, and we are going to see Baba can increase take rate from Taobao and Tmall. So that's why we think that we have buy ratings for both Tencent and Baba. That's why we have the title, Can Elephants Dance Again?
Okay, Shawn, well, I know Baidu is on the other side of that, but let's stick with Tencent, and a question to both of you, Shawn, and maybe you can chime in, Robert, too, on this. Shawn, a big focus from investors, not so much the business for Tencent, but the buybacks. Can we expect the rate of buybacks to continue here for the company?
Yeah, I think so. I think they have enough cash, and especially thinking about that, they have much better performances online gaming this year, and online gaming is a high margin business. So I think they have very good cash reserve to support their buyback program. And also, I think that buyback seems set to be something that's behavior that exists across all China internet companies, and Tencent seems to play the lead. So we think that the buyback could continue for Tencent.
Robert?
Yes, I have to agree with that. The level of cash generation across the sector is still very healthy, and particularly bearing in mind the valuations across the sector, there is actually scope, I think, for companies to perhaps announce enhanced buybacks at this set of results, assuming they're, hitting numbers. But I think for a company like Tencent in particular, that is, one potential upside risk from where we stand at the moment.
In terms of catalysts then, Robert, what else are you watching out for the sector?
The Tencent story, whereas if you wind the clock back to about 12 months ago, the games business was really suffering from lack of hits and the slowdown in what is ultimately a slowing and saturated market. The story's changed, and it's really very much being driven by games at the moment. So we expect that to continue through the next quarter or so on the back of new gaming releases, and particularly DNF Mobile, which has made all the headlines in recent months. So that momentum should continue. But I think looking more forward, the growth, to be a very sort of obvious point, but the growth momentum and the earnings momentum of the sector is going to all normalise into next year. So obviously we're going into a slowing economy. So whereas Tencent, for example, should deliver, 25 to 30% earnings growth this year, investors should still bear in mind that the earnings growth will normalise next year. 10 to 12% growth appears a reasonable estimate at this point. So to call it a slowdown is perhaps an exaggeration. It's more normalisation once that initial, wave of gaming growth plays through, I think.
Shawn, let me bring you back in. So let's wrap up the topic on the elephant. So Baidu, so Tencent is the top for you, then shortly behind Tencent is Alibaba. Baidu is last, and you say the company is challenged. Tell us why.
Right. I think that's the Baidu's challenge mainly from the search, core advertising businesses, because we see Chinese internet users, their search behaviors are migrating to other vertical platforms, like Douyin, like Xiaohongshu, the Little Red Book, and also WeChat search. So I think these platforms, they have enough content, and they are ramping up on their search capability. On the other hand, Baidu is emphasizing on AI, and there are a lot of other AI startups in China. And the problem is that Baidu tries to transfer their search result to more integrate the AI summary, but that means that the users will spend less time on Baidu mobile app, because basically people can only read the summary of the AI like generative results, then that means that Baidu probably is going to lose some like ad loads. So that's, I think, in terms of the like competitive landscape and in terms of the challenge brought by AI, that's the two concerns we have currently.
Robert, you've been talking about this as well, that, Baidu once was sort of the leader in this whole AI story, and they've kind of lost a bit of momentum now. How do you see China positioned in AI compared to the U.S. now?
Okay, one thing I've said sort of consistently over the last 18 months or so is that the technical barriers to entry on AI on the software side are not particularly high. Whilst, compare and contrast again with hardware and semiconductors, you're trying to produce chips at the cutting edge of physics, so that's incredibly difficult to do. But the fact that there are now several hundred Chinese companies with large language models developed at this point in time, whereas, at the beginning of last year there were close to none, again, just reinforces this point that the technical barrier to entry just isn't there, and that has significant long-term implications on the abilities of these companies not just to break even but turn a profit. So there is a price war in the Chinese large language sector that will continue for the foreseeable future. And again, that has implications on the ability for particularly the likes of Alibaba, which strategically has put huge weighting on AI as a potential growth driver, and also, again, the likes of Baidu. I was really hoping Shawn was going to be really bullish on Baidu so I could try and cut that argument down. But, I think the two of us are in quite strong agreement on that front. Baidu has a very fundamentally challenged outlook.
Right. Shawn, let me ask that question to you then. Why aren't you convinced that AI could change the core business for Baidu just yet? And how are you looking at AI, for example, for these other elephants, for example, as whether that's an asset, a future investment, a revenue enhancer, or simply something nice to have?
I think for Baidu, the AI has two implications. One is for its core search business. I think this is more like a challenge. But unfortunately, I think most of Baidu's profits coming from high margin advertising search business. On the other hand, that Baidu, I think they have some advantage in autonomous driving, robotaxi. We have seen this kind of reports. But unfortunately, it seems that's still a very far away picture. So at current level, I think that Baidu seems to face more challenge than opportunities in terms of AI. On the other hand, that you ask about the overall picture of AI. So I think that's probably that AI could come in several phrases. So the first phrase, current stage, I think it's more about technology advancements in terms of big language model. We have seen that in the West. But unfortunately, I think due to various reasons, it seems that Chinese internet companies, they don't really want to talk much about that. But on the other hand, that if you compare with the mobile internet, and the second stage, probably it's going to be more about application, about software, about the things we are going to really see some impact. And then at that stage, we're probably going to see these China internet companies will be more active, because they're better in terms of data, in terms of application, and in terms of user scenario.
I was going to get your take on the e-commerce space as well. I know Alibaba's the second on your list in terms of top picks, Shawn. How does that compare? I mean, the competitive landscape, we just talked about Colin Wang from PDD now becoming one of the richest men in China now. How does that competition fare now between the likes of Alibaba, JD, and PDD?
We actually downgrade PDD about 2 months ago. So we in that report, we upgrade Baba, but downgrade PDD. I think that's mainly because it seems that we see that PDD is facing some pressure from some other competitors like Baba and Douyin. On the other hand, that we think that PDD's Temu overseas business probably is going to lose a little bit more money than we thought. And I think 2 months ago, the consensus number was very high. If you look at other sales side analyst estimation, so that's why we said that we see that increasing competitive pressure, and we see high consensus number. That's why we downgrade PDD at that time. On the other hand, we also have a neutral rating for JD. I think mainly because that JD seems that their business model is more emphasizing on logistic, on brand products, on high value products, And this is something seems that to be like less favorable by the Chinese consumer now. So yeah, I think that our pecking order is still above our first, and we have PDD and JD like seeing more challenges.
Right. And it's worth noting, Shawn, that the ratings, of course, also reflect the short-term movement in stocks, right, and what might outperform from here short-term. But tell me this, or riddle me this: who do you think among the three will have the biggest e-commerce business in 5 years' time?
In 5 years' time, I think in 5 years' time, because I think that currently that Baba still has. I think probably is still going to be Baba, but I think PDD is going to grow even faster than like other competitors. I think in 5 years, our estimation is that PDD's GMV will be close to Baba, but still like a little bit like but that Baba is still going to be the largest player in China e-commerce.
Shawn, appreciate the time. Shawn Yang, their senior research analyst at Arete Research. Also want to thank our very own Robert Lee, Bloomberg Intelligence's senior analyst, of course, covering all things tech as well. We take a look at what it comes to what we just heard just now in court. So now we heard from Kaisa, there was an adjournment there for that wind-up hearing. Times China also, that wind-up hearing adjourned to October in a Hong Kong court. Now, we also heard from Kaisa, the company aiming to finalize that restructuring agreement in 4 weeks. Right now, Kaisa Group shares, though, still down about 5%. This is Bloomberg. Welcome back to the China Show. Japan is closed for Mountain Day today, so hopefully you're heading to the mountains and hiking or something.
Not dollar yen, please.
No.
No, I think
we
we're
don't
done
need any
with
more
the
of
hiking.
that.
No. Or rates.
We take a look at the CSI 300 is faring here right now. We're still seeing a little bit of upside, about 0.1%, but not nearly as much as some of the rebounds that we're seeing and the gains that we're seeing across equity markets here in Asia, with Taiwan, with the Kospi really leading the charge here today. So tech is catching a bit here this morning, and we're taking a look at dollar yen. We're trading still around those 146, 147 levels. So we're still seeing that weakness, and maybe that yen carry trade unwind is subsiding for another day right now, Dave.
Yeah, when you look at across markets, really, I mean, the several parts of the macro conversation, right? What does the Fed do with rates? Where do we go with U.S. election risk? What does the Chinese economy look like in 3-4 months' time? And what do these geopolitical hotspots look like? Israel, Hamas, and of course where you are with Ukraine and over in Russia. Now, underpinning really all of this is what the cost of borrowing will be as far as the Fed goes at the end of this year, and who might the new president be, and what they think, or what their position might be as far as the Fed conversation goes. Because Donald Trump, of course, I think it was last week, talked about how he might want to have a say when it comes to monetary policy. In the meantime, though, Kamala Harris, Democratic nominee, says that she would respect the Fed's independence if elected president in November.
The Fed is an independent entity, and as president, I would never interfere in the decisions that the Fed makes.
And Harris is looking to draw a contrast with Republican nominee Donald Trump, as we just said, who says presidents should have some say over interest rates and monetary policy. Former Treasury Secretary Larry Summers also told us he disagrees with Trump.
The reason why countries all over the world, this isn't just an American thing, but countries essentially all over the world have moved to independent central banks, is that they recognize a profound conflict of interest.
Now, we also asked Summers whether the Fed needs to actually come in and deliver an emergency rate cut after the recent weak spate of economic data.
On current facts, given that there has been some recovery, given that volatility has come way down, we're not out of the woods. You can't be certain. The Fed certainly needs to be watching carefully. But I think an emergency response would be lurching, panicked, overheated, and counterproductive on current facts, which doesn't mean that the Fed shouldn't be watching very closely. Before they have another decision to make in September, there's going to be a lot more data that's going to come in. And I think they should make clear that they're going to be watching all that data and they're going to make a decision reflecting the need to balance the concern of making sure that we have stopped inflation with the concern of maximizing employment. And I think they need to not be pressured into specificity of a kind that is impossible. And when this Federal Reserve has made mistakes, the mistakes have been of overconfidence and overly firm statements that prove to be unwarranted in light of the data as it evolved. And so I think they just need to say they're watching carefully and they'll do what's appropriate. But certainly no move between meetings. It may be that a 50 basis point cut is appropriate. We just don't know. Anything's possible. The huge excitement about 75 basis point cuts that followed immediately after Monday, I didn't think any of that was warranted at that early stage.
Larry, let me pick up on one of the things you mentioned, which was volatility. The VIX really did spike up to, I think, over 60, maybe the highest it had been since the pandemic first hit. How much attention should the Fed pay to that volatility index, what it might be telling us about how the markets are functioning?
I actually think that the SEC and the relevant exchanges may want to pay a bit of attention. My understanding is that because there are some illiquid instruments that go into the calculation of the VIX had a somewhat artificial movement on Monday, that if one looks at the VIX futures, which are a somewhat different instrument, the movements were much, much less dramatic. So I certainly had my attention caught by the VIX early in the day on Monday, but as I have looked into it, I think you were learning more about issues around liquidity in the options markets than you were about some profound reassessment of the American economy.
Former U.S. Treasury Secretary Larry Summers there speaking with David Weston on Bloomberg Wall Street Week. Let's bring in Christy now, investment strategist at Franklin Templeton Institute. We can start off with volatility, really, just given what Larry Summers had mentioned, Christy, that, you know, we've come down from those levels that we saw, the panic levels that we saw just a week ago when it comes to volatility. And we're seeing a decent bounce back right now across risk assets. I'm just wondering, is now the time to get back to equities?
That's a great question. Let's start from the beginning. I think if you look at where the S&P 500 was last October, it was at the lows, and then from then to July, it has rallied 38%. And we're looking at multiples in the equity markets around 24x. And expected earnings, that's around 13-15% for forward PE for 2025. So all that backdrop suggests that there is very little room and margins for disappointment. And that was exactly what we saw last week. So the markets got dislocated. And, you know, to your question as to when is a good time to come back in, I think we would really focus on several opportunity set. But probably at this point in time, a lot more volatility is still forthcoming. And we want to look at some of the technical indicators, perhaps, you know, in terms of the RSI and also put-call ratio. It suggests that we are not yet at the buy zone. So in terms of when is a good time to come in, we probably will have to sit tight for another probably another round of volatility as markets mood swings between a risk off, where the yen carry trade unwind still continues to suggest some uncertainties, and then also risk on when U.S. recession risk are panning out, increasing, but not yet at the very elevated level. And we're looking at some resilience within the U.S. economy from the data points going forward. So I think that's the kind of mood swings that markets and investors will be subjected to in the near term before entering a buy zone for equities.
What about fixed income? Because David here, by the way, Christy, because yields have dropped substantially. I think the 2 years down about 100 basis points from where we were at the peak of the year at least. And is it even worth taking the risk of additional duration at this point? Now we know rates are going to come down, but have markets already more than priced that in, is my question.
Yeah, so spreads have widened, I think, across the fixed income space, but it hasn't widened to level where, again, we'll be comfortable in taking more duration. Or at the same time, I think U.S. Treasury yields have come to a level where it is not at this point in time attractive for extending duration. So we do suggest taking some of the profits of the U.S. Treasury's positions, and at the same time look for some of the opportunities. And even if spreads widen further, and we do think that that will provide some attractive entry levels, we would still focus more on quality in the fixed income space.
Christy, what we've been seeing recently, given some of these recession calls being priced into this bond market, is that inverse relationship with stocks and bonds seems to have come back after years of being in doubt. And we're actually starting to see bonds come back in favor in some way as almost like a defensive play, a hedge. Are we likely to see this relationship stick this time around?
Well, there is a probability that when the Fed starts to cut rates and when the Fed starts to actually commence on an interest rate cutting cycle, and we expect that to start in September, and going forward, that will provide a more conducive environment for fixed income from where yields are at the current levels. And we've been saying since the start of the year that we don't expect the Fed to be aggressive on the rate cuts. In fact, we don't agree. We disagree with markets where the expectations of 5 rate cuts from now until the end of this year. We do think that the Fed will be gradual in its rate cutting cycle. And so that actually provides room for the inversion in the yield curve to actually normalize. And that is actually a conducive environment for investment grade and also for the high quality fixed income going forward. In the high yield space, there are definitely still some opportunities, but we would actually also continue to focus on the more higher quality, high yield credits.
Right. So equities, not just yet. Fixed income, maybe not just yet. That leaves us, Christy, with what? It's either cash, alternatives, or if you would allow me, Dogecoin. So so what do I do with my money now?
That's a great question, David. I think with the cash that you have, you definitely can put it into better use in the fixed income space. And again, I think I will emphasize on the high quality sectors. And then I think in terms of the 60-40 type of portfolio that we have seen with the negative correlation in terms of equities and bonds, that will still play out well. Now, the area to actually, I think, focus on is actually on portfolio resilience. So yes, I would say that you can add a little bit more in terms of gold, in terms of some of the, perhaps if you would like to get into crypto, that multi-asset perspective will actually add and enhance to your portfolio.
And private credit, is that still something that's an interesting space to you?
Well, private credit, I think it still has a long runway, mainly because at this point in time, we're looking at, the maturity wall, and the supply of credit to markets will be at a higher for longer types of interest rate environment. So in that sense, banks that are interest rate sensitive, and they are still, very, I would say, reluctant to lend to certain areas and certain sectors. That is where private credit will continue to fill the gap, and the runway is still ongoing.
Christy, have a great rest of your week ahead. Thank you for joining us this Monday. Christy Tan there investment strategist at Franklin Templeton Institute, joining us out of Singapore this morning. Just ahead here in shows, this big story out of India, massive one here. You had ahead, of course, the market regulator denying claims by Hindenburg Research of conflicts of interest over the Adani Group, the details of the story, and the pushback just ahead. This is Bloomberg.
Watching India futures here this morning, we're pretty flat on this Monday morning as we count down to that open there. But the head of India's market regulator has now strongly denied allegations from Hindenburg Research of conflicts of interest around investigations into the Adani Group. Just the latest twist in this whole saga, right? The short seller published a report on Saturday claiming that the Securities and Exchange Board chief and her husband made investments in products also backed by the brother of billionaire Gautam Adani. Let's get to our Mumbai bureau chief, Anirban Nag, joining us now for more. Anirban, tell us a bit more about these allegations and how significant are they?
Well, in the broader scheme of things, they are significant, and we are getting into a situation where Hindenburg Research is having a really mighty go at the SEBI, which is the capital market regulator here in India. Now, the basis of this is that the regulator had sent a show cause notice to Hindenburg Research a year ago or thereabouts, and Hindenburg Research thinks that SEBI has not yet done a thorough probe of the Adani group of companies. So it's in that broad context that you've got to look at these allegations that Hindenburg has made, which are based on a whistleblower, documents. Now, you've got to look at it in the broader context, in the sense that SEBI chairperson Madhavi Puri Buch has been an investment banker, and along with her husband, they had made investments abroad when they were private individuals working abroad. Hindenburg Research says that some of those investments were related to the fund in which Vinod Adani, the brother of Gautam Adani, has been invested. But there was very little way to know that the two are linked. So it's very tenuous at the best. But the regulator is pushing back on these very serious allegations.
Anirban, thank you so much. Anirban Nag there, our Mumbai bureau chief, telling us obviously there the two sides to the story, and certainly we're waiting for market reaction, potentially, if any at all, of course, in the next hour when the market opens up. Let's stay in India though, because India is poised to narrow the gap with China in the MSCI gauge for developing. So that's the EM gauge here for MSCI here. Let's bring in our equity senior reporter Abhishek Vishnu to talk us through this. And we know India's done well, Abhishek. We know China not so much. How soon might India be able to overtake China within, of course, that specific EM benchmark? And what does it mean, really, for broader dollar investors?
Hi, David. So, the expectations are that either in this review, which is set to be unveiled tomorrow, early morning Asia time, or by the end of the year, India might command higher weighting than China, which means there would be a new EM stock anchor. At least 1 percentage point increase in rating is possible, mostly funded by China and at expense of other markets. And what it means, that question's answer lies in how things panned out for China. If you look at the playbook of what happened with China, then India would become more appealing to global investors despite its valuations. There would be rising chance for higher standalone allocation for India. And what it means for EM is, the EM index actually becomes more growth-oriented. It offers more choices between growth and value. And, on the flip side, it becomes a bit more expensive, given India's valuations.
Taiwan, Abhishek, seems to be in this race, too, almost neck and neck with India. What are the odds of that overtaking China?
That's true. Taiwan commanded about 18 percentage points weighting in the MSCI EM index as of end July. And it was moving neck to neck and actually overtook India, was there for about 5-6 months. And this was largely, reflecting the rise of non-China chip trade across the world, given Taiwan holds TSMC, the bellwether. It gained a lot of heft. Now, if Taiwan overtakes, and even if it doesn't overtake, this essentially the rise of India plus Taiwan is actually showing that there is a multipolar investing world emerging in emerging markets, offering more choices to investors. So that changes how EM investing has been, looked at or done since China came on the screen.
Yeah, Abhishek, to add to that too, recently because China has not done well, you do have, EM ex-China strategies, you have pure India strategies. How does a bottoming out in the Chinese equity market reverse some of the things we've seen in recent years? In other words, what the pushback would be if in case China turns in terms of that, keeping that weighting on Taiwan and India in check?
I agree. I mean, that's a big to be sure. There is a bottom in place, which we saw earlier this year. Hopefully that things would stay like that or improve from here. Now, we need to understand there is a cycle of stocks going out and coming in. So there would be time before China actually, keeps any sort of check on India-Taiwan. And it has to deliver a big stimulus or a huge economic, performance for investors to take notice and become a lot more confident, especially the Western investors. Valuations definitely are appealing. One more thing from China's playbook when, China's heft became what we have seen over the last few years, is it at a weighting of 25, 27, 28% it starts becoming an issue for global investors. But hey, China commanded 40% weighting at its peak. So a multipolar investing in emerging market, that's a theme that's here to stay for a few years.
Abhishek, thank you. Abhishek Vishnoi there, Equities senior reporter joining us. We got plenty more ahead. Got some more Olympics. Well, the last of our Olympics to really talk about here as well. Get the latest on the medal count. And of course, what to look ahead to too. This is Bloomberg. Yeah, this is the last time we're checking, of course, how the Olympics and the medal counts. Okay, so U.S. and China basically tied when it comes to gold, but then again, the USA takes it when it comes to total medal count. But yeah, those medals are getting a little bit pricey. They're worth quite a bit too, Dave. And
that's because of this geopolitical risk premium that we've been discussing here on the shows, right? So this melt up in prices of precious metals has driven up the input costs, if you will, of what it takes to produce a medal. So I think we're now at $900 here for gold. And no, don't do the math on how heavy it is and the ounce. We already did it for you. It's $900. But yeah, and I guess it goes to show that there is some monetary value to what you win in. But I guess for gold medalists, they could not care less really how much that was worth. It's just an added bonus to everything else about winning a gold medal, right? The glory, the fame, everything, right? And of course, all that hard work. And then we were talking about the closing ceremony, right? It was quite interesting where you had the likes of Billie Eilish perform. Then I think the icing on the cake was Tom Cruise, right? Taking that baton, that torch to L.A. L.A. is in 4 years' time. So I guess who better to really do that, right? With a stunt and everything, and it's LA. Oh yeah. He does his own stuff, of course. There he is. Although I could think of other names that might have been able to do it. No, I'm kidding. Nah, you got to get the whole Mission Impossible thing, right? And then you got to take it back to Hollywood. Yeah. Okay. So if you think winning a gold is impossible, maybe not. Maybe you and I should try for an Olympic sport in 4 years. I'll try breakdancing. I think that the barriers of entry are a bit lower there. There's a low barrier there, in case you missed that story. We'll leave you with a look at casinos. Why not? Some news here that driving down stock. Citi says it's a buying opportunity. This is Bloomberg.